Get on board, get on track, get to where you're going. And now, your EduTrainer, National Insurance columnist, Steve Savant.
Well, welcome everyone. I'm Steve Savant, your EduTrainer and coach on our edutainment workshops, and we're doing our entry-level introduction into life insurance. And all this week, we're doing our introduction into variable universal life, and today specifically, we're going to introduce you to some VUL, or variable universal life spreadsheets. But before we do that, I want to again tell you about downloading our software that we're using in our teaching and instruction. We really voted Lincoln Benefit as probably one of the easiest tutorial softwares or illustration systems, and if you want that, and we recommend it so that you can go page by page with us, we want you to go out to their site, www.lblsales.com/ETW. That's www.lblsales.com/ETW. As soon as you come out to their site, go ahead and hit Run Installer. It'll install the software for you, and then when you go online with us, you can go page by page with us. It's an excellent tool, and it'll really help your learning experience. We also, LBL, and you can see the actual at the bottom of the screen, and I also have this in our search engine optimization description. It actually has that in there too. It's rather long to talk about it now. You can go out to this site, and it actually has a couple pieces here that I think are excellent tools provided by Lincoln Benefit. One of them is the Facts of Your Life booklet. It can either come in electronic form or book form. It's a great harvesting tool for your clients' assets, and also so many things that I never would have thought of, they put inside this book. It's an excellent piece, and if you do use the electronic version, again, you say, Steve, I can't remember how to get there. Can you send it to me? Be happy to do it. Just write me thebiz@brokersalliance.com, and I'll send it to you, no problem. Also, they have several prospecting letters as well as prospecting postcards. These are excellent tools. If you say, boy, I don't even know how to talk to my clients about this. I'm in my workshop, but I need some pieces or material or some campaigns. I have several here, and just use any one of these. Just remember, if you're FINRA licensed, you're still going to have go through compliance of your broker-dealer to say your approval on this. And remember, these are really good pieces, great client retail pieces. And lastly, I want to talk about this. If you missed any of our shows, and we always recommend that you go out to the beginning of our classes and really go through the beginnings, because a lot of things we're talking about today, I've already talked about in foundational thinking, and I want you to be able to grasp what I'm talking about, but you need to do the basics first. If you need to do that and say, Steve, I don't know how to do that, you can go out to our site, www.brokersalliance.com, and as soon as you come to our homepage, just hit our on-demand red button video, and it'll take you into all our edutainment workshops, all on our introduction to life. And just a little heads up, in the corner you can see that's our Business Insurance Zone, our daily internet talk show that happens every day. You can watch that, and we're always talking about great things on that show. So without further ado, I want to talk about a few things though before we get into this, and that is I want to talk about the basic ideas that we're going to bring up. And it's just kind of a tool that I want to talk about. When I'm looking at VUL, it's generally for people who want some extra added cash value. It could still be a death benefit play. Some people use it for both. Some people are more premium purists, where they like either this is indemnification or it's an income play, and you shouldn't mix the two. But just to make sure that you fully understand what you're getting into, actually VUL can be sold, believe it or not, with limited guarantees on the death benefit. Limited guarantees on the death benefit. That means that some will say, well, if you pay a required premium, you might get up to 20 years of guaranteed death benefit. Remember, it's not guaranteeing any cash values. It's just guaranteeing the death benefit. And some carriers will let you pay a little higher required premium on variable universal life, and that can guarantee it sometimes from age 100 all the way out to life of the insured, or a lifetime guaranteed. Now, I'm not saying this is the best way to do it. If you're doing it for strictly a death benefit play, I'm not certain this is the way to go. It's a very expensive tool to use, and I don't know if it's really going to give you the bang for the buck coverage. But if you have people that say, but I like the ability to have access into the market, and I like the tax advantages of that. Well, if you do it for income, then you're not going to be using any of these guaranteed premiums. But if you say, I just want to make sure that my death benefit's there, you can either purchase a limited guaranteed death benefit, or You can purchase a age 100 to almost all the way out to lifetime in some of these contracts, as long as you pay their required premium. And remember, that's going to be different from carrier to carrier, how they price their model out. But again, just a heads up, if you're doing this for indemnification only, I don't think this is the way to go. It's just a little too expensive for my taste. Now let's go to our first grid to kind of show you where this marketplace is. And this grid is just current, printed out just this last May 2012. This spreadsheet is really very recent. I mean, this is less than 60 days old. And if you say, Steve, I'd like to have your guaranteed VUL spreadsheet as well as this current VUL illustration spreadsheet, which is really golden, as well as the one I'm going to show you, you can just write me, thebiz@brokersalliance.com, THEBIZ at brokersalliance.com, and I'll send you the grid. This is all brought to you by the way, these grids are really great, and they're done through an organization called Full Disclosure, and they're an excellent tool, especially for history on policies and all the provisions. It's really quite an excellent software package. Well, I'm on the grid right now on this, and here are the basic parameters of this specific spreadsheet. We're using a level death benefit, option A, in a lot of the language that we use, and we're showing an 8% gross rate. Remember, we haven't taken the expenses out on the actual allocation model. We're just showing an 8% crediting rate. And then the net average sub-account charges that we're trying to put in here, we try to get it as close as we could to making it average. Again, there's going to be a little higher, a little lower, but it's pretty close to the same game. We're using $1 million on a male age 40. We're using the best non-smoker class, and we're using a actual annual premium paid annually at $7,500 for annual premium. And remember, this is assuming that every state is charging for these policies that there's a 2% premium tax, because remember, it's going to be a little higher, a little lower, but we had to pick something that would be somewhat down the middle and pretty much common among all the states, so we chose 2%. Now, when I look at this grid, it's really outrageous, and I'm hoping you can see it pretty well. Again, you can order it, thebiz@brokersalliance.com, and I'll send it to you. I'm looking at this, and it gives me 5-year increments for the cash accumulation and the current accumulation, which could mean the difference between the actual cash values and surrender values, but it also gives me, this grid shows me the actual current death benefit amount, I'm sorry, not death benefit, accumulation account in the 30 year, the 40th year, and the 5th column is the internal rate of return. Now, one of the things that I'd like to say, and this just holds true for indexing, I can't predict what indices are going to do. I can't predict what equities and bonds will do. I have no idea. What I can do is get reasonable about whose platform, whose mortality chassis, what VUL actual contract has probably good current company practice, and especially if some of those current company charges on their policies are contractually guarantees, which even makes it more important and better. I like to kind of look at that because that's kind of what I know I am for sure buying. What are my expense loads in this policy? And I can kind of go out and look at it, because if everything is being equal as we've done on this spread, the only difference now that's showing here is expense charges and a little bit of difference in the asset allocation model charges, which we tried to be as close as we could. Now, the reason I bring this up is because, as an example, all the way out into the 40th year, we're looking at the internal rate of return on cash accumulation. And I'm at 4.87 on one contract, but the next contract down shows me at 5.67. So it's almost a full 100 basis points rate of return. The only difference here is, of course, is my expense loads. As I travel down the grid, there are some at 5.92, which is nice and high when you look at this total grid. And there's even one that's sitting here as an internal rate of return at 6.29. When I look at a contract like that, I'm going, wow, their expense loads are very small compared to their competitors. The second thing I want to know is, are those current company practice charges inside the contract or showing on the illustration, are there any contractual guarantees on those charges? Because that's when you start separating the players from the pretenders. There's so many carriers that are trying their best now to make current company practice and their contractual guarantees very close. You got to give them some wiggle room in case they don't price correctly. But to me, this is a pretty fair grid, and it's showing you kind of mapping it out. So what I'm doing on this grid is I'm basically looking at the accumulation numbers, the internal rate of return, and then I want to know what the minimum premium to endow at their current rate. And that shows this entire. So if I'm looking at this as a death benefit, I look at this grid and I can see this is the kind of minimum premium I'm going to need to endow this contract at current crediting. Look at these numbers. They're all over the board. One costs almost $7,800, while there's a couple of them down at the $4,200. It really makes a difference to shop these prices. And the last thing I want to talk about on this grid is it'll also show the endowment period, how long, and most of these will go out all the way out. There's a few that don't go all the way out to endowment, like all years could be age 100. It might be all the way out to 120. You'll want to look at this grid, but to me, this is a great grid. And again, you can order it from me, thebiz at brokersalliance.com, and I'll be happy to do it. Now, what I want to do now is I want to show you our second grid based on income performance. Now in this grid, we're going to show you some income scenarios and some numbers. And believe you me, I had to do this based on how full disclosure does it. If I would do this grid, and it would take me too long to do it, that's why we love these guys, they do a great job, I would actually attack this spreadsheet a little bit differently if I'm doing it ultimately for income only. But let's just look at the income, because it'll give an idea of what we're talking about. We're taking our variable universal life product and we're looking at it as an income illustrated value. And what we've done is we've done this and looked at it in most states. What I'm about to say is going to be true. Remember, each state's going to be different. Before moving forward, always make sure that your state Department of Insurance is okay with the way you're explaining it. There's some variations, and that's one of those issues of being FINRA licensed. Now, what we're using today is we're using an increasing death benefit at the front end, and then we're leveling it off at age 64. We're showing at 8% crediting rate, and again, there's going to be a net difference here depending upon each contract. We've tried to make the weighted average as close as we can. We're using a male 40, preferred non-smoker class. We're using the guideline minimum death benefit at the beginning of the contract period, or non-MEC, and we're using a $10,000 annual premium paid until the insured reaches 64, 25 premiums, and then a level death benefit income stream from age 65 all the way out and we're using here first basis and then loans, and we're making 20 payments to age 84, which is what they're targeting as basic life expectancy. So it kind of gives you an idea. Now, when I look at this, I'm just looking at all these contracts. And here is the current death benefit. On most of these are sitting somewhere around 8 to 900,000 for this. Again, I think I could have made this way lower and got more numbers out of it, but that's just, we're trying to do something a little differently here. But when I look at this, I'm looking at years 25, 26. In these years where I'm looking at age 65, what have I accumulated in my cash? So I'm looking at the current death benefit and the current cash values. So right now, if I'm putting in 10,000, I want to know, wow, what's the actual return on this? Is it good? Is it bad? Is it a good deal? Is it a bad deal? And I can print on almost all of this, and I'm going to show you this tomorrow. I always like to put in the internal rate of return because I want to know what my net effect is, money in, money out. If you look at these income streams or these accumulations, you're going to notice that they have such a difference because the expense loads, once again, are so different. And I've taken the maturity date and I targeted at age 100. So when I'm trying to measure, is this a good deal? I'm looking at more measuring what the expense loads are on this per carrier, trying to make it as even as we possibly can. So I want to measure this out and make a quantitative judgment. Which contract for income, not death benefit, but for income, is going to generate the most cash? And when I look at a spreadsheet like this, the cash values are so different that I'm going to be looking at carriers from $46,535 of annual income all the way up to, I think I saw one at $57,000. I thought I saw one at 60, but about 57,000 is your book-in quotes, from 48,500 up to 57,000. That's a big deal difference annually every year for 20 years. So it's very important to look at this grid. If you want to order this grid, just write me, thebiz at brokersalliance.com, THEBIZ at brokersalliance.com, and I'll send it to you.
This has been an Edutrainment Workshop, the educational division of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, and sponsored by Lincoln Benefit Life, an Allstate company.